So let's take a real quick look at closing revenues. We're going to close a revenue account to retained earnings, right? So this is essentially just saying we've got revenue here in this account, and we need to move it over to the retained earnings account, okay? So retained earnings, revenue we know increases and decreases, increases with a credit, decreases with a debit. We know that retained earnings increases with a credit, decreases with a debit, right? So if we're moving from this one to this one, we need to reduce it on the debit side and increase it on the credit side, okay? So we close revenue accounts with debits and increase retained earnings with credits, okay? This is what it looks like from a numerical kind of perspective, right? Our balance in sales revenue was $350,000. This is straight from the examples that we've used throughout chapters 3 and 4. We need to close that. We need this balance to equal $0. So we need to reduce it by $350,000, okay? Then we add some service revenue in the amount of $25,000. Same case, we need it to equal 0. So we're going to reduce it by $25,000. And we're essentially just taking these and we're moving them to retained earnings, okay? Because it's our retained earnings, it's just our net income that we're going to keep after dividends, right? So now we have $375,000 in retained earnings. Our beginning balance was 0. Our ending balance is $375,000, okay? So what's that look like as a journal entry, right? Well, it's going to look a little backwards and look a little weird to you because we have been talking about crediting revenues to increase them, but remember, now we're trying to decrease these revenues, right? So we're going to be debiting those to decrease them. So we're going to debit sales revenue for $350,000. We're going to debit service revenue for $25,000. And then in order to increase retained earnings, we need to credit it, right? A credit to retained earnings is an increase, which is in turn an increase to stockholders' equity. We're going to credit it for $375,000. This is a closing revenue entry right here, okay? We are zeroing out our revenue accounts and taking that money, that balance, and moving it to retained earnings. That's all we're doing when we close, okay? We're just closing these temporary accounts. So right here, we're really just looking at the retained earnings T account, okay? So we're just going to track this periodically once after every closing transaction. We're going to take a look at what does the retained earnings T account look like now. So we can see this is closing entry number 1. This just stands for closing entry number 1, okay? Just makes it easier for us to go back and refer to it. So right now we can see that our credit balance is $375,000. That's great. And why is that good? That's because retained earnings has a normal credit balance. Okay, we would expect our ending balance in retained earnings to be a credit. So closing expenses, okay, is a little different because we're going to do the opposite thing here, right? We're trying to reduce our retained earnings, so in the end, we want to debit retained earnings. That means we're going to be crediting these expense accounts. This means cost of goods sold, salaries expense, rent expense, supplies expense, depreciation expense, interest expense, income tax expense. All of these are expenses. All of these are temporary nominal accounts, right? They all also live on the income statement, right? So we're going to close these out. We're going to close them all to retained earnings, okay? Now, once again, I'll just remind you, we're going to close these expense accounts with a credit, and we're going to increase, we're going to decrease retained earnings equity with a debit, right? We're going to decrease it with a debit, okay? So, closing some expenses. Now, this is a lot to look at. This looks very confusing when you first see it, but all we're doing is we're listing each one of those expenses, their beginning balance, right here, and then the amount we're going to close, which is all of it, and then their ending balance, $0, okay? So, here's our retained earnings. We started at $375. We had a total amount of $330,000 worth of expenses, so these are our closing entries. This leaves us with an ending balance of $45,000 in retained earnings. So let's take a look at what that actually looks like, okay? So this is our actual journal entry. Notice it's December 31st, last day of the month. We need to close our books. So we're going to make these closing entries. We're going to close all of these nominal accounts to $0, okay? So here we're going to debit retained earnings because we're decreasing stockholders' equity, right? Retained earnings is a credit normal account, so if we want to decrease it, we are going to debit it. Here, we're crediting all of our expenses: cost of goods sold, salaries expense, rent expense, supplies expense, depreciation expense, interest expense, income tax expense. Notice again, all of these are reductions in expenses. We are decreasing in expense. Now, I told you guys earlier in this chapter, we always increase expenses. This is the one exception to that, right? We are decreasing these expenses because we want them to equal 0, right? So we're going to close all of these out. So we're going to credit them. If we debit to increase an expense, we credit to decrease it, okay? So it's a big, long journal entry, but it makes sense, right? You're hitting a lot of different accounts, and you're just showing the amounts for each of those accounts, okay? And in the end, really, you can tell our debits equal our credits, right? There's $330,000 debit. These added together is $330,000. Okay, so our debits equal our credits. Closing dividends, we close in a very similar way to expenses, right? Because they're doing the same thing. Dividends are trying to decrease retained earnings, okay? So we decrease retained earnings with a debit. We close the dividend account or reduce the dividend account to 0 with a credit. So again, here's our beginning balance, okay, $45,000 in retained earnings. We're going to close the dividends, reduce that by $14,000. We're going to reduce this retained earnings by that same amount, and we have an ending balance of $31,000. Okay, and here is the journal entry for that. You can see here, again, we debit retained earnings to decrease it. We're going to credit the dividends to decrease those as well. Okay. This is what our T account will now look like. Journal entry 1 was closing our revenues. Closing entry number 2 was expenses closed. And entry 3 was dividends closed. Okay. And this is our ending balance at $1231. Okay. So we will finish up chapter 4 in the next video, but if you got any questions or comments, please feel free to contact me.